Hey, hello, Jack Tubbs from the J Team at Realty One in Surprise, Arizona, wishing you a fantastic Friday. It is the weekend, and it's going to be a beautiful one here in the Valley. Might be a little bit cooler, but we're going to have plenty of sunshine and a lot warmer temperatures than we've experienced for the past couple of days. Hey, this is the last installment of the week when we're talking about down payment assistance, and especially we're looking at the Home Plus program here that is offered in the state of Arizona. We've gone over what the requirements are. We've gone over exactly what an down payment assistance is. That it's a secondary lien, but it's at zero interest and no payback. But you're going to basically, it's going to be forgiven depending upon how it's set up. And most loans are going to be 36 months. So at the end of 36 months, the entire secondary lien is going to be forgiven, and then you can refinance or whatever you want. If you do it before then you're going to have to pay back whatever the balance is left if you do not wait the full 36 months. And then there are some other programs, and we're going to look at that today, that make the down payment assistance, the secondary loan, run for the entire length of the mortgage. So wherever you're at when you decide to refinance, especially when we're working with like an FHA, Fannie Mae, Freddie Mac, one of these programs where you can put less than 20% down. Once you get to that 20% equity mark, most people want to refinance so that they can drop their PMI, which is private mortgage insurance, which insures the lender up to 20% of whatever the value of the loan is, so that when they go to sell the property, if should they have to foreclose, they know that they should be able to recover the money to cover the money that has been borrowed to purchase the home. So we talked about basically the FHA. We found out that the down payment assistance can be either 3, 4, or 5%. It's a 36-month payback. Minimum credit score is 640. Maximum income is $109,965. Maximum debt to income ratio can be 50%. And the maximum loan value is, of course, 96.5% of the loan, leaving you that I'm letting you know that 3.5% can be the down payment. And then we have a different one depending upon how you finance it. You have the FHA loan that the secondary mortgage is going to be for the life of the loan, but you will automatically get 5%. Once again, 640 is the same minimum credit report. And then also the maximum amount of money that the borrower can make, like we saw in the first regular FHA, that is $109,965. This one's going to vary by county. So it's going to be vary by county that you're in. Once again, debt to income ratio is the same, 50%. 96.5% of the purchase price can be the mortgage. Now, manufactured homes. This is something different here. Don't do a lot of manufactured homes, but it can be either 3 or 4%. But the credit limit, or the credit score, is higher. It's 680. The income is the same. Debt to income ratio is going to be less, though. You can't have any more than a 45% debt to income ratio. But once again, it can be 96.5% of the balance of the mortgage. And then there's an FHA U.S. military. 5% is automatic. 640 is the minimum credit score. 109,965 is the maximum income. And then 50% can be the debt to income ratio. And then once again, 96.5%. Now, we move into Freddie Mac, which is a little bit different because most FHAs are going to be under Fannie Mae. This is a Freddie Mac. And then it says it's got some other different, there's 2 different levels of this, and then one of them is based on whatever the area median income is. And that means that the person who is buying the home, or the people that are buying the home, that their net income, now we have to pay close attention, net income can be 80% of whatever the median income is for the area. Now, when they say this with an AMI, or area median income, it means after you pay your bills, your taxes, all these other things, what's left over is considered your part of the area median income. As long as it doesn't reach past 80% in this one loan that we're looking at here, it's called the FHA, or the HFA Advantage, which is part of the Arizona Home Plus. You've got to be under 80% of the area median income. Once again, it's kind of variable on what the down payment assistance can be. Either be 0, 3, 4, 5%. Minimum credit score 640. Once again, income requirements are going to change by county. Debt to income ratio no more than 50%, and this can be 97 to 105% of the loan value. So that means that there's also some money in there to do any remodel work that might be done, minor stuff. It's not going to be major things, but minor things. And then they have the Freddie Mac HFA Advantage life of the loan, and that means that it's basically everything else is the same except it's an automatic 5% on the down payment assistance. But that down payment assistance, that secondary lien, is going to run for the life of the loan. Minimum credit score 640. Once again, it's going to be variable from county as what are the maximum income requirements are. Debt to income ratio is still 50%, and once again, this is another one, 97 to 105% of the loan value. Now we're going to look at the some of the other Fannie Mae programs that are out there, and they're going to sound really familiar. They're going to be a lot like the Freddie Mac as when we get to the HFA preferred tier of what Fannie Mae offers. Once again, it sounds exactly like the Freddie Mac. It's going to be 3 or 4% though. They're not going to give up to 5% of the 5% for the down payment assistance, but it's going to be 80%. It has to be over 80% of the area median income, 640 up to 109, 965, 50% debt to income ratio, and this is also a 97% to 105% of the entire mortgage value. And they have two other programs the same. The only thing that are differences is that one is going to be the life of the lien. In other words, the down payment assistance is going to run, that secondary lien is